If your crypto portfolio didn't perform quite the way you hoped this year, don't worry. You might still be able to turn that pain into a financial win. It's called tax loss harvesting, and today I'm going to show you how crypto investors can use it to legally reduce their tax bill. Now, before I begin, please keep in mind that this is not financial or tax advice. This video is for educational purposes only, and your situation may be very different. Always consult a tax professional in your region who understands crypto reporting laws before making any official decisions. So, what is tax loss harvesting? In simple terms, it's the process of selling crypto assets that are currently down in value in order to offset gains from other assets that you sold at a profit. The losses you realize by selling can be used to reduce your taxable income. Let's walk through an example. Imagine you bought Solana at $100 and now it's worth $50. If you sell your Solana now, you'll realize a $50 loss per token. That loss can be subtracted from any capital gains you've made this year. For example, maybe you sold Bitcoin earlier in the year for a $5,000 profit. If you realize $5,000 in losses from Solana, those two cancel out, and now your taxable gains are effectively zero. That means zero capital gains tax owed for that $5,000. Pretty powerful, right? And it gets better. In many jurisdictions like the US, if your capital losses exceed your gains, you can use up to $3,000 of the excess to reduce your regular income for the year. Any leftover losses, you can carry them forward to future years. That's the good news. Now let's talk about how to do this responsibly and legally, especially in crypto, where things move fast. The first thing you'll want to do is identify assets in your portfolio that are currently worth less than what you paid for them. This means going through your transaction history and finding your cost basis for each asset. That's what you paid, including fees. You can use tools like CoinLedger, Coinly, or CoinTracker to help you with this. These apps automatically calculate your gains and losses based on the blockchain data or exchange API connections. Once you've identified those loss-making positions, you can choose to sell them before the end of the tax year. In the US, that's December 31st. But if you're in another country, make sure you know the exact deadline. Now here's where it gets interesting. In traditional finance, if you sell a stock at a loss and then rebuy it within 30 days, that's called a wash sale, and the IRS disallows the loss deduction. But in crypto, there's currently no official wash sale rule, meaning technically you could sell your losing coin and buy it back minutes later, still locking in the loss. But, and this is a big but, just because that loophole exists doesn't mean it's safe forever. Regulations are evolving fast, and some lawmakers have proposed closing this gap. So always use caution and don't try to abuse the system. If you want to stay safe, a good strategy is to wait at least a few days, or to rebuy a similar asset instead of the exact same one. For example, if you sold Aave at a loss, you might choose to rebuy Compound or another DeFi token to maintain some exposure without triggering regulatory scrutiny. Also keep in mind, tax loss harvesting only works with taxable accounts. If you're holding crypto in a tax-advantaged account like a retirement fund or a crypto IRA, this strategy won't apply. The losses have to be realized in a taxable environment to matter. And one more tip, if you're planning to sell assets at a loss, consider the transaction fees. If you're on Ethereum and paying $20 or $30 in gas fees per transaction, and the loss you're realizing is only $50, you might be wiping out most of the benefit. Choose your timing carefully and avoid high fee congestion if possible. So let's recap. Tax loss harvesting can help reduce your capital gains tax by selling assets at a loss, locking in those losses to offset other gains or income. You can reinvest the proceeds, but watch out for timing and make sure you're staying compliant with local laws. And above all, use tracking tools to stay organized and always talk to a tax professional before acting. Now, if you're serious about getting smarter with your crypto, check out learningcrypto.com. We've got beginner-friendly guides that explain these strategies in simple language. No hype, just real-world help. Thanks so much for watching. I'll see you in the next video.